In this video, I'm going to cover the pros and cons of indexed annuities, the tricks that insurance companies use to make them sound good, and how much you really earn, and then a few other things as well. You've probably been hearing a lot about fixed index annuities lately. That's because these investments are touted as a way for you to invest in the stock market without exposing your capital to risk. Not only that, when you're ready to start making withdrawals, you may elect to get a series of payments that will last as long as you do. And if that weren't enough, if you die, there could be some life insurance benefits for your beneficiaries, depending on the contract. On the face of it, it sounds appealing, especially the part about being able to invest in the market and avoid catastrophic losses. Now, if you suffered terrible declines in your investments last year, which many people who invested in the market did, that's got to sound good. But the question is, do index annuities live up to that hype? Now, by the time you finish watching this video, you'll know if fixed index annuities merit your consideration or not. First, what are index annuities? Fixed index annuity is an investment with an insurance company. What makes it unique is that it gives you the opportunity to participate in stock market growth without taking any risk in the stock market, like I said above. Now, that can help you grow your money faster than low interest CDs in the bank can, and it does so without you having to worry about a stock market crash. Index annuities share many attributes of fixed annuities. While you leave the money with the insurance company, it grows tax deferred. Withdrawals are partly taxed as income rather than capital gains, no matter how long your money's invested. And if you withdraw funds prior to reaching age 59 and a half, you get slapped with a tax penalty from the IRS. Of course, each contract is different, but they all have surrender penalties, which means that on top of the IRS early withdrawal penalty, the insurance company might penalize you if you make a withdrawal, no matter how old you are, depending on the contract you sign. Now, while we're on the subject of withdrawals, let me explain what I said at the start of this video. At the end of the contract, of course, you have the option of taking all the money out as a lump sum over a period of fixed number of years. But at different points in time, you also have the option of annuitizing and collecting a series of payments that last as long as you live. Can't really explain annuitization in this video. It would take us too long, but we'll release a video on that important topic very soon. So please subscribe and smash the notification bell so you're informed when we release that video and other videos in the future. The characteristics I explained above are common to all annuities. What differentiates the indexed annuity is how the money is invested, and more importantly, how your returns are calculated. But before we go too deep, let me remind you that before making any investment decision, I strongly advise you to speak with your own financial advisor. What I'm presenting here is strictly informational, educational. It is by no means designed to provide you with any investment or financial advice. Okay, how is an index annuity invested? When you invest in one of these contracts, the insurance company invests part of the money in the stock market, the other part in bonds, using specially designed options which are created specifically for the insurance industry to back the participation of the annuity contract. Now, I don't think the specifics are worth diving into. It's very complicated, but I just want you to understand how the money is invested. Usually, the stock market portion is invested in the S&P 500 index options. So for purposes of our discussion, we'll assume that that's the index being used. Depending on your contract, you earn only a portion of the stock market's return over some period. They can't give you everything the stock market earns over that period for a couple of reasons. First, they have to make a profit. And second, when you buy an indexed annuity, the insurance company guarantees that you won't lose money in most cases. That's the big selling point. But that insurance costs money, and you pay for that insurance by being credited less than what the insurance company earns on your money. How does the insurance company calculate the return on your investment? This is important. There are a few steps the insurance company takes in order to calculate your return. First, your contract will spell out what's called the participation rate. As you might guess, this is the percentage of the market increase you theoretically keep. So for example, assume you bought an indexed annuity that was tied to the S&P 500 and the index went up by 10% this year. If your participation rate was 85%, you might earn 8.5% because 85% of 10% is 8.5. But it's not that simple. Most insurance companies also have a cap on the interest that you can earn. In the above example, if your contract had a cap of 6%, you would only earn 6%, even though the market was up 10 and your participation rate was 8.5, you'd earn 6. But you know what? It's still not that simple. Some insurance companies calculate the return of the index using a point-to-point system, and others use a more complex method. With the point-to-point method, they'd look at the index value on, let's say, 1/1/23 and compare it to the value of the S&P on 12/31/23, and they calculate the return. It's very simple. That approach usually yields a result very similar to the return calculated by the publications for the index. If that's the method used by your indexed annuity, consider yourself lucky because it's usually the most advantageous approach for investors. But other insurance companies calculate the average returns on a quarterly, monthly, weekly, or daily basis. And rather than get into the weeds on this, let's just say that the more complex the crediting system, the less advantageous it is to the investor. I'm going to provide a few more details, but first, please subscribe and smash the notification bell so you're informed when we release videos on this and other topics of interest to you. Many years ago, I found a Fidelity investment study that said that a typical indexed annuity would have earned about 7% per year less than the overall market from 1926 through 2013. That's right. Over that period, an index tied to the S&P 500 clocked a 10% average return according to Morningstar, while the typical indexed annuity would have credited only 3%. That's because of the participation rate, the cap, and most important, because of the way the insurance company calculates the return. I looked for more recent studies and I couldn't find anything, so we'll have to leave it there. Just understand that the way the company credits your interest is a huge factor in the bottom line return. Let's compare the indexed annuity to the index itself. Let's take a good indexed annuity that has a straight annual point-to-point crediting system, an 85% participation rate, and a 6% cap, and we'll compare it to simply investing in what's called SPY, which is an ETF that invests in the S&P 500. On the left, you see the S&P returns for SPY year by year, 2013 through 2012. You can see that it included a lot of great years, a couple of fair years, and one terrible year. You can see that starting in 2013 with $100,000, this hypothetical value at the end of 2022 reached $324,000. Now look at the growth in the indexed annuity. Because the cap is 6%, that's the most this contract will earn in any one year. That means when the stock market was skyrocketing like it did in 2013 and 2017, this indexed annuity was growing at a much slower pace. Having said that, we see that in 2018 and 2022, when the market lost money, the fixed indexed annuity didn't. But was that protection really worth it over 10 years? Well, in this case, no. The person who invested in the S&P 500 ended up, hypothetically, with more than twice the amount that the indexed annuity investor has. Granted, this is only one 10-year period, and the likelihood of this sequence of returns repeating itself over some future 10-year period is remote. And like I said earlier, this particular period has some great years, and because the contract of the annuity caps the maximum return at 6%, the annuity forfeits all those great years in exchange for protecting investors against horrible years like 2022. Now, let's look at the period between 2000 and 2010. We'll see a very different result. The fixed annuity works out much better than the ETF for the S&P 500. That's because that decade was one of the worst decades for the S&P 500 ever. You can see that the ETF investor ended up with only $103,000 hypothetically after 10 years, while the annuity investor ended up with over $144,000. That's because the annuity investor didn't lose a ton of money during the bad years, such as 2000 through 2002 and 2008. Look at what happened to the ETF investors' values during those same periods. They plummeted, while the annuity investors' capital remained intact. But should you invest assuming that the future holds the worst case scenario? Well, that hasn't been a winning strategy, because even with all the bad years, the stock market over the long run has still managed to return over 10% annually on average, and you won't earn anything like that from an indexed annuity. Of course, the past is no guarantee of future results. In summary, people are attracted to the indexed annuity investments because they promise participation in the stock market without the risk. Sounds really good on the face of it. But if you look at the details like we just did, you'll understand that the returns may not be as attractive as you imagine. First, the cap limits you doing well during great years. Next, the interest crediting system, if very complex, could really cut down on your potential returns. And on top of that, remember that all your gains are taxed as income, which is a higher rate when you make withdrawals, rather than as capital gains, which is available through the stock market itself. From a long-term investment standpoint, I think most investors can find better returns than those offered by fixed indexed annuities. They do offer peace of mind, and that can be worth a lot. But if you're after long-term financial security, I think there are better alternatives, as I said. Now, for more ideas on how to secure your retirement, please subscribe to our channel and smash the notification bell. That way, you'll know when we release future videos for you. Also, be sure to look in the description below of this video. You'll see a link to join our Facebook group where you can interact with others about retirement issues. And also, we have links to our free booklets on 10 different retirement topics. I think you'll enjoy them.